Why are so many SaaS companies failing? Why are their stocks down 80, 90%? We want to talk about this today for a couple of reasons. One is it's an interesting case study for investment. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. And we cover many aspects of the hedge fund business here. And one of them that we obviously have to cover more often than not is also, well, how come you sometimes make money and sometimes you don't make money? I mean, this is a very important little detail that sometimes people like to forget. So it's absolutely crucial to think about a couple of things. So you have this innovation, let's say cloud computing, which is definitely something that sort of emerged in the 90s. Then you have I would say a boom. You have a boom first in the cloud providers, AWS, Microsoft, Google, etc. And then you have all the adapters, and that's where really the sort of the rubber meets the road here, which is, okay, what happened here? We have a lot of these people, a lot of companies, and I want to use two companies in this particular episode just as examples. I have no axe to grind here. I'm not invested. I have never invested, nor am I short anything. But they're very good examples of how this mania turns into, well, something else, something less interesting, maybe even dangerous. One is Monday.com, the other is Asana. Both do something that I would say, well, that's where the problem already starts. It's relatively hard to describe what they do because they're in the realm of other companies like Slack and Dropbox, which are other companies. Let's put them in together. So we have Asana, Monday.com, Slack, Dropbox, and then you can keep going. Companies that I would say help people manage their professional lives, and there's a lot of good stuff that they do, and they do it in the cloud. And you can even throw in Workday there and companies like that. NetEase, which was bought by Oracle, they just help businesses manage themselves. NetEase and Workday are a little bit more enterprise-driven, but still similar stuff. And let's get back to the sort of the Slacks and the Dropboxes and all those companies. And the problem with those companies is they just don't make money. They don't make money, and they're, I would say, terrible investments. Sometimes, if you're lucky, you get out without really losing a lot, but most of the time you really get burned terribly. And the question is why, and how can hedge fund managers see these kinds of things? And we certainly don't have a crystal ball, but there's certain principles that you can use and certain fundamental just ways of looking at the world, which I think are very helpful. And this is what we want to discuss today in this episode. This is Not Even Wrong podcast. It's September 7th, 2022. This is Krim Telco. Since the last update, we're up about 3%. The market is up 1%. For the year, we are down 30.2%. The market is down 17%. We're underperforming by 13.2%. So let's talk about these companies, Monday.com and Asana, two SaaS companies that help people manage their lives, organize their professional lives particularly. And the problem is these stocks have gone up and then down. They're down like 90% from their highs. And I would say it's really questionable if there's anything there actually tangible. And maybe at this point, the way they're trading in the market is, of course, as potential acquisitions for maybe somebody like Microsoft or Oracle, since the only way out for these companies seems to be that somebody buys them for their customer base, maybe sometimes for their IP, but it's probably just the customer base and the workflows that are already in place that, let's say, somebody like Oracle could just buy and integrate them into their platform and then just go from there and be happy-go-lucky and maybe make more money and be successful with that. So that's the way this stuff is trading. And as an investor, you then have to think to yourself right now, okay, I'm buying something which is pretty much dying, and the only reason I would make money here is because somebody else could, instead of let it die, just buy it for like I said, the customer flow, the workflows, the existing relationships, which are very hard to build. These are things you can't just code, so you have to buy it. So this would be the situation. We at Orange Capital Partners don't do any of that stuff. And the first question that comes up here is not even like, are these good investments? But the question is a lot more like, how did we even get here? What happened here? why did these companies surge and then collapse? Why did that happen? And you can, like I said, you can throw in Slack, even companies like Block and Atlassian. I mean, even them. Although I would say that that's a different caliber of quality there, and particularly Atlassian probably has more standalone value. But the problem is the following: you have this cycle in the tech world, particularly in Silicon Valley, which is we have a new paradigm, a new compute paradigm. Compute paradigms drive innovation, they drive venture capital, wealth creation, all of that stuff. At least that's how it has been. It could change now, but I would say compute paradigms are still the fundamental driver of wealth creation. So this is number one. This is very important. So what is a compute paradigm? A compute paradigm is, and this is why I find Onur Mutlu's class so important, because the compute paradigm question really is the question of the compute stack. And it starts, if you want to go from down to up, it starts with the physics. So what are we actually using? What kind of transistors? Or are we maybe using quantum computers now? Are we using physical substrates like ion traps or superconductors? And then what kind of gates? And then what kind of logic and compiler and software and programs? And then what kind of problems can we solve? This is the stack in a nutshell. And that's why I think Onur Mutlu's class, the most important class. If anybody is listening to this and has any, let's say, idea, or sorry, excuse me, if there's a problem out there for anybody, what should I be looking at in terms of educating myself? What class should I take? Take Onur Mutlu's class, whatever. Just go on his YouTube channel and look at his, because he's really doing, I think, what Silicon Valley as a whole is doing, which is think about the compute stack from like pretty much any angle. So up, down, like he said, you look at it from up, down, present, past, future, everything, and think about where it's going, because this is where, at least so in the last 50 years since the existence of Silicon Valley, this is how money has been made. And now, what is a compute paradigm? A compute paradigm is when there's changes in the stack. And why does the stack change? Well, typically it's an innovation. Let's say we had mainframe and then we went to PC. And why did that happen? Many reasons, but the main reason was memory became cheaper. So you could do the von Neumann compute model on a smaller computer by having memory going back and forth to the processor, constantly executing and all that stuff. Versus in mainframe, everything was a lot more rigid because memory was so expensive. Also, processors were much less powerful. So you had to do, put everything in a place, and then it goes somewhere, and then gets executed, and it goes back. And now we have the internet. Now we have cloud. We have also software 2.0 paradigm. So things change along those lines together. Why can't we just do that as a sort of offer compute like an electricity thing, or the consumer model, as Michael Dell calls it? Why can't we do that? The new compute paradigm today, and this is where the rubber meets the road with Onur Mutlu, the new compute paradigm today is we have software 2.0, which is Andrej Karpathy's thesis that we write software, we have algorithms that are designed to basically take in data and then morph into something useful. So the actual work that is done in terms of creating something useful is through the algorithm and the data consumption. This is a new compute paradigm. It requires data-centric compute. It requires a new computer architecture, hence Onur Mutlu's work, and that's why we are so excited about that class. But this episode is not about Onur Mutlu's class. This is about the idea of why Asana and Monday.com are not doing well. So please forgive me for getting a little bit on too many tangents here. Let's get back to the basics here. So why aren't they doing well? We have a new compute paradigm in the 90s, which is cloud computing, distributed computing, certainly parallel to the internet, or maybe the internet is even sparking that whole idea. I don't care, but the idea of distributed computing. So then you have companies first in the realm of, let's say, Salesforce.com, which does sales management and all that stuff, and then you have NetEase, and then you have Workday, and now you have Monday.com, Asana, many others that Dropbox, that just say, okay, look, I'm going to take a certain facet of your problem set, let's say in the business life, and I'm going to offer that to you in a consumption model. And that's how we had, I would say, since the mid 2000s until recently, we had this massive boom. The companies were founded probably in the late 2000s, in the late 90s, and then they were existing for between 5 to 10 years. And now I would say most of them are, like I said, if they're public, they're trading at all-time lows, and if they're private, they're probably desperately trying to find a buyer. What's going on? Why is this happening? In a nutshell, what's happening is that the cost structure of these companies is not in order. They have way too high costs for the kind of revenue that they generate. Now, you can, when you look at cost structure, you can always say, well, the cost structure is not in order because the revenue is not high enough, or you can say the revenue is fine, it's just you need to find a better cost structure. Louis Vuitton has relatively high cost, but their pricing is so high that they have very high margins. So does Hermes. Tesla has high cost relative to maybe other car companies, very high relative to their cost, and therefore they can make a very good profit. And the reason the pricing is high because they offer a product which is just so massively better than anything else that is offering the same service. Let's say in the case of Tesla would be an electric car, an electric luxury intelligent car that just hasn't happened. It hasn't existed before Tesla, and therefore they have pricing power, and that's why their margins are good. They're relentlessly driving down costs, which is the right thing to do, and that's why we're very excited about this investment in the long term. But let's get back to those cloud providers. The reason, let's say, companies like Monday.com and Asana are not doing well is just simply because they can't make money. And the reason they can't make money is because they don't have a control of their cost structure. Their costs are way too high, and the reason they're way too high is because a lot of the value that they provide actually goes to the cloud providers. So it's AWS and Azure and Google that are actually making the money. It's not the, like, say, the Asana. So they are sort of attack. And I was thinking about an analogy, and I'm sure I have to check that. I'm not sure, but I don't have facts, but I'm sure that when electricity became ubiquitous, so let's say after Edison and Westinghouse fought their battles, and we started connecting the world with electricity, I'm pretty sure there were lots of electric companies that were offering services where they took electricity and did something for you. For example, did your laundry, or did certain machine work for you, or all that kind of stuff. And I think we still have that today. We have laundromats and all that stuff. But of course, nobody thinks about these services, or even let's say shops that do tooling and all that stuff, which is basically they're using electricity to drive machines, and then the machines do something. And you could say, well, why don't I do this at home? Well, because this is kind of like a cloud-based electricity provider. So instead of taking the electricity to your home and then you do your laundry at home, they did the laundry or dishwashing and all that kind of stuff. I'm sure it happened when electricity became ubiquitous, and then we had paradigm shifts in electricity where then General Electric and all the appliance industry grew, and so on and so forth. The point here being is the following, that you have a similar development now in compute, where you had this cloud-based compute which offered many companies to do services, piecemeal services. In the case of Monday.com and Asana, it's literally things like scheduling and scheduling meetings, and in the case of Dropbox, is literally just saving your files somewhere in the cloud. I mean, that's I'm sure 5-10 years from now we'll laugh at that. But what was that even a business? That should be totally ubiquitous, and you shouldn't even know where your files are anymore. Why is there such a thing as a hard drive and a cloud? You just save your files wherever they need to be, and you get access to them whenever you want them. So the problem with these companies again is that their service, while useful in a maybe small world, is just not good enough to justify the high cost that they have. And the high cost comes from the fact that the three big cloud providers really control the pricing of cloud compute. And the question now for these cloud providers, of course, is, okay, how should we price this so our customers don't die? So we want them to survive. We're going to give them a little bit of profit so they can keep going, but we have to price it in a way so they don't die. And this is, of course, a very difficult task. And to cut a long story short, probably they haven't figured out a very good way to do that. And that's why we are in a situation today that, like I said, companies like Monday.com and Asana are basically almost bankrupt, and many, many others. And if you look at There's a VC company recently I came across, and they had a deck, and the deck was a little bit old, maybe 6 months old, where they were bragging about all these SaaS companies that they invested in. And then if you look at their portfolio, the public listed portfolio of the companies that they invested in, it's all down 90%. And God knows what the private portfolio is doing. Now, I don't know if this VC made money or not. That's a whole different story, because, of course, you don't know what the cost is. And maybe in the long run, if you look from a Silicon Valley perspective, it's actually not so bad, because if you invest in a company like Monday.com in early stage, and they get maybe to a valuation of, they go to from a valuation of 10 billion at the high down to $1 billion, but you're invested in early stage, even the $1 billion today is still worth something to you as an investor. But of course, that's always a difficult thing to assess, because you never know where people's costs are, and people like to say, well, I made money here, I made money there, when in reality, the money hasn't been made. And I can keep throwing in companies here, even Zoom, which has made money for investors, but I would say a lot of investors, probably if you look at the median of actual investors who invest in Zoom, they're all lost money because they all bought way too high, given how sharp the correction was. Then you have companies like Lyft, Uber, this whole slew of companies, which aren't exactly typical SaaS companies, but similar in the realm that they just have a way too high cost structure to survive. So I guess the conclusion of this episode, now I'm getting to the point, and I'm sorry, maybe I was a little bit going around different subjects, but the point here is the following. When you invest in companies, always think about the cost structure. Companies are defined by their cost structure. That's what a company is. When a CEO talks to you about his company, you should, and he only spends time talking about the cost and the way they drive down costs, you're on something good. It doesn't mean that this is going to be the next Amazon or Microsoft or Netflix or whatever, but it's at least something. And it's funny I mentioned Netflix. One of the reasons we never invested in Netflix is because Netflix isn't that kind of company, isn't that type of company actually. Netflix rarely talks about the cost. They only talk about revenue, and that's not a good thing. You want to have a company that is relentlessly focused on cost. Now, of course, you need to worry about revenue, you need to worry about a lot of things, but the cost is where it starts. You are defined by your cost structure, because that's what you actually do, which is on a daily basis, you build a factory, you spend money, and then your cost structure is what you do. Like somebody once told me, if you want to run a business, you need to do cost accounting. That's the most important class in business school. And by the way, I agree with that. Cost accounting is the most important class in business school, because that's when you learn how to run a business. It's not about strategy. It's not about, fancy financial accounting, Wall Street stuff, investment theory, macro, micro. All of these things are fine. But the real thing, where the rubber meets the road, is cost accounting, where you learn how to allocate fixed costs and variable costs, how to allocate, how to think about R&D, how to think about, let's say, capitalizing versus hitting revenue right away. Like all those questions, in my view, are the most important questions, because they define what a company actually is. And cost accounting is the way to measure what a company actually is. So if you have a company, and I think Tesla is that kind of company that spends a lot more time on the cost and the way they think about cost and all those kinds of topics than on the other side of the ledger, which is, we have this phenomenal growth and the sales and the products. All of that is important too, but the cost is really what matters, particularly on things like earnings calls and stuff. So I guess to summarize, the reason now this new compute paradigm, the compute paradigm of the noughties, which is cloud computing, which I think is now coming to an end, and it's going to be replaced by a new compute paradigm, which let's call it data-centric compute, or software 2.0. Like this new compute paradigm, this compute paradigm, or the cloud compute paradigm, is coming to an end, and it looks like most of companies will not survive. The ones who will survive are the providers, and a few companies, maybe like Atlassian and Salesforce.com and those types of companies that have been around for a long time, that have been growing into the role of the roll-up, which gives them the power to buy all these failed companies and actually make something out of them. So that's really a lesson. The purpose of this podcast, again, is to give people a sense of what it feels like to run a hedge fund. And while this is more practical advice now, when you look at let's say this new compute paradigm that is coming now, the software 2.0 paradigm, uh, think about it. Like, companies will emerge here. They will tell you, well, we're doing machine learning, we're doing this, we're doing that. Think about the cost structure. Think about, okay, given this cost structure, what is your revenue potential? What kind of unit costs, gross margins can you actually have for real? Think a little bit about cost accounting. Don't just take their books for granted. Think about how they allocate the cost. You can often see also in the way costs are allocated for, I mean, again, sorry for the tangent here, but one last thing I want to say is a lot of companies, let's say, companies like Instacart or Lyft or Uber, all these companies, in my view, all failed companies because their cost structure is way, way too high. But what they would say is that we have 80% gross margins, and then they have a very high line of sales and marketing, which is really where a lot of their costs are. So they would say something like, well, we gave discounts to our customers, but the gross margin is 80%, but then sales and marketing takes the hit, and then, in the end, you just don't make money. So again, look at the cost. A company is defined by the cost structure, and the cloud, the SaaS companies, which are all failing, or most of them are failing right now, they're all defined by their cost structure, like any other company. And the reason they can't make money is because most of the revenue, most of the actual value add is going to the cloud providers and not to the SaaS companies. And this is a very important lesson for any hedge fund manager. Be very relentless about the cost structure, because a company is defined by the cost structure. Thank you.